Okay. So, just some summary information here. We'll do some work with these. I want to talk a little bit about these, but I want to use an example, and we can do that in our synchronous class. But just some important formulas that we've seen up until now. So the next thing to think about is, okay, so what if I went and did a different plot of, for essentially the same time period that we're talking about, and I sort of said, okay, the horizontal axis is going to be my historical volatility, okay, or standard deviation. And then my vertical axis is going to be essentially my return. And I went and I sort of did a plot. Treasury bills were on the low end here, right? The lowest volatility, the lowest return. Corporate bonds were the next lowest, but they were higher than treasury bills. So higher return, little higher volatility. World portfolio, higher return, higher volatility. So in other words, what I sort of saw in my visually, when I organize it, it looks like there is sort of this, hey, if you have more volatility or risk, you have higher return, right? And so we're sort of, if we drew a line through that, that would make sense. Now, what's interesting though, let's say that I just took the S&P 500, okay? And then I broke it down and said, all right, I want to see, I'm going to say the 50 highest market cap or highest value stocks in there. Then I take the next 350. Then I take the last 100, right? And I represent them either with diamonds, diamonds, triangles, or circles. And you'll see them all over here. Now, what's interesting about this is, do you notice that none of them, even the furthest left diamond of all of the, somewhere in the 51 to 400, that volatility right here is still higher than the volatility of the S&P 500. Now, keep in mind, the S&P 500 is the returns of all of these stocks combined, and also the volatility of all these stocks combined. So if you think about the return, the S&P is kind of in the middle of all this, right? So it sort of reflects the average of all the stocks' returns. So you don't get the high one, you don't get the low one, you get something in between. But the risk, interestingly, wouldn't you think the risk would sort of be in the middle here? But it's way over to the left. So what's happening? Well, if it doesn't come to mind right away, this actually illustrates the benefit of diversification. The S&P 500's volatility is lower, much lower than the typical stock's volatility, okay? And that's because diversification helps us reduce risk. We'll talk about why coming up here. So from the previous chart, the relationship between risk and return seems to hold pretty well for large portfolios. That would be all of the, the red blocks, right? Because those are portfolio stocks and corporate bonds, etc., and mid-cap stocks, small company stocks. But individual stocks don't follow this relationship, right? Remember, I looked at those S&P 500 stocks, and they were all to the right, which means they had higher standard deviation than the S&P 500. So no clear relationship between risk and return for individual stocks. Larger stocks maybe seem a little less volatile than small company stocks, so that would be sort of I think it's the triangles. Probably as a rule are a little bit to the left, the circles are a little bit to the right, the diamonds are kind of somewhere in between, but definitely when you look at all the individual stocks seem to have higher risk and lower returns than the larger portfolios. And I would say not so much lower returns, it might be sort of like more, they represent an average of the returns in the portfolio, but definitely the S&P 500 portfolio has a lower risk, okay? So up till now, we have three basic understandings of risk and return, right? Risk is measured by volatility, so therefore standard deviation. The greater the risk or the standard deviation, the greater the expected return. And the opportunity cost of capital discount rate is the required return on projects that have similar risk, okay? And we've talked about that in previous chapters, but that's something that we understand right now too. Okay, but that's not enough. We got to think a little bit more about this. So risk is uncertainty about future outcomes, right? We don't know necessarily what the future is unless we hold a T-bill, which is the risk-free asset. We know what we're going to get paid, essentially. So looking at past risk and return, in other words, after the fact or ex post, while helpful in understanding future risk, can be misleading when defining risk premiums about future or ex ante expected returns. We talked about this, for example, when we looked about trying to integrate inflation and thinking about risk-free returns, right? We have to use expected inflation. We don't necessarily know what that's going to be, and the same holds for risk premiums. So the other thing to keep in mind is not all risk is the same, okay? So how do expected and required returns change as the risk increases? All right, so that's sort of what we like to say. We kind of know they go up together, right, and down together. So risk goes up, return goes up, risk goes down, return goes down as a general rule. But maybe we can be a little bit more refined in how we define our model for a risk premium. So let's start by talking about a couple different kinds of risk, okay? So required returns do not increase linearly as the overall uncertainty increases. So there are some risks that are unique to the firm, right? Hey, we could have a fire at a production facility. We could have the death of a CEO, failure of a new product, the success of an R&D project, right? So we refer to these firm-specific risks as independent or unsystematic, or sometimes I'll just refer to them as firm-specific risks. So because these systematic risks offset across many firms, they are unrelated. And that's actually a big benefit, because as I become more diversified, in other words, let's say I have a portfolio, and all I mean by a portfolio is I'm holding more than one security, right? Oftentimes portfolios, if you have the S&P 500, you have a 500 security portfolio. But what happens is these firm-specific risks start to cancel each other out, right? Hey, one firm's doing really well right now. Oh, the other one's not doing so well. Oh, this one's doing reasonably well. This one, oh, they had a fire at a production facility. The other one had a really successful product launch. So all of these things mixed together, these firm-specific uncertainty risks start to cancel each other out as you start to diversify. So that's important to remember. Now, the other side of this is we have what's known as market or systematic risk, right? Some risks affect all firms: recessions, changes in tax law, increased interest rates, some new technology, oil prices, inflation. These are sort of like macroeconomic factors, okay? Sometimes we refer to these non-firm specific risks as common or systematic risks, right? I'll oftentimes refer to them as market risks, but these common risks generally impact all firms, but the level of the impact is going to differ depending on the firm, okay? So individual firms may be more or less exposed to these kinds of risks, okay? And that's going to be important to understand as well. Okay, so now the question is, I decide I'm going to hold a diversified portfolio. That's awesome. So what do I do? Well, diversification is often thought of as don't have all your eggs in one basket, right? But that's a little bit less than what we would like. Diversification is the reduction in unsystematic or firm-specific risk an investor achieves by combining unrelated assets. Remember I said, look, once you start to diversify, some of these firm-specific issues are going to cancel each other out, right? And that's going to overall help you lower your risk through diversification.